of what we're seeing in the previous slide. So in the previous slide, we're just seeing an extract of a couple of years out of this timeline. And what that's showing is the top bar is obviously operating revenues, and then the green line that drops just below that is the cash flow from operations. And what that effectively is showing is that you have an exceptionally high level of cash flow from operations because the operating costs within the model are relatively static and small as a proportion of the overall costs. Now, what happens below that line is obviously the remaining portion of that cash flow from operations then needs to be carved up to pay back the investors. And obviously sitting very at the bottom of that is the operating profit before tax. So that's showing the depreciation impact, so clearly not a cash flow impact, but in the early years where you have significant depreciation flowing through until that catches up.
Sorry, what's the difference between operating revenues and cash from operations?
So operating revenues is the top line. So if we go back a slide here, so operating revenues there you can see is the first bolded line. So that's effectively your top level of your P&L, so revenue and income. And then below that, the operating, what do we call it? Cash flow from operations is effectively the second bolded line there. So it's after your costs go out.
But your cash costs, but before depreciation and interest.
No, okay.
Yep.
The operating costs are escalated at some inflation rate similar to the price of the water?
That's correct, yeah. So they're based on an assumption of CPI, which is applied to the same number as applied to the revenue as is applied to the operating costs.
So that from a farmer perspective in these out years, I saw somewhere the ultimate cost of the water at some out year, I forget the year it was like 52 cents a cubic meter or something.
Yeah, so that would be the 26 cents, which is proposed on day one, just continuing to escalate at CPI.
And so farmers would have to perceive that, while they're locked into this contract anyway, but they'd have to perceive that those, what you're calling flat operating expenses, are nevertheless justifying them paying twice as much in those out years for their water as they started.
Well, I mean, what you're effectively paying the same margin at maturity because, you know, both your revenue line and your cost line are moving at the same rate.
Yeah. So I think that if you come back to this slide here and in the table of sort of metrics down the bottom there, you've got the third line down there, which is your operating profit margin. And what that's showing is that as you continue to gear up your operations, so what you can see in that first full year of operations is that your margin is less because your cost base is relatively fixed. So there's some variable costs around the pumping, so you'll save some costs if you're not pumping 100% of the footprint of the distribution network. But as you continue to lift revenue, obviously revenue lifts, but that cost base stays relatively static. And what you can see in the out years there in the last three columns at full uptake, once CII is repaid at the end of the first consent period, is you've got a static operating profit margin.
Well, I asked the question because in a previous briefing, I seem to recall Jim Scotland saying at one point that there would be points in this process where there was some sort of potential recalibration of the pricing because there might be, in fact, a political issue that farmers felt what they were paying was getting out of whack with what the actual cost of operating the system were.
That may be, but I mean, I guess the key point, of course, is that, you know, the one of the fundamentals of this scheme is that the farmers aren't paying for the dam, aren't paying for the infrastructure, and therefore you have to have a price and a price structure that rewards the people who are paying for that infrastructure. Now, farmers obviously have the choice of sort of diversifying their risk in relation to that in terms of investing in the scheme themselves, but at the end of the day, you can look at what they have to pay for the water, but you also have to, the other side of that equation is the capital costs they've avoided by not having to make that investment.
But I just to supplement your question there, But it does beg the question, though, doesn't it, from a farmer's perspective, why should I have my water indexed at the rate of inflation, incurring a cost structure which is an average of everybody else's costs, but might not be the actual costs being incurred by RWSS? RWSS's rate of inflation and actual increase in costs might be well below what the national average is. So why should I pay the national average when it might not be?
Well, there's two questions. Clearly, that's the farmers are going to have to factor that into the decision. But the difficulty is you have to sort of determine if you're going to make a major investment in a piece of infrastructure like this, you do have to have some rules of the road established up front for the project to fly. And so, if you vary those terms, then someone else, none of this stuff's free, right? So, if the farmers don't, accept that price risk, then where does it go? Because either, the flip side of it, someone else is wearing that risk.
I think the other thing to note with that is, that ultimately the nature of farming is that it's variable year on year, because it's clearly subject to commodity price cycles. So what farms have, and farmers will know, and banks will know that fund farmers is they'll have good years and bad years, and ultimately this is just one portion of the cost line in a farm, and that top line revenue is going to vary based on the commodity cycle, and the rest of it will vary over time. So it gets back to the nature of farming, which is ensuring that in the good years you tuck away some money for the bad years, and ultimately it's just one input to many inputs that sit on farm, and it just happens that this one is indexed at CPI. And as Alan says, ultimately the decision will be made as you go through the process and signing those water agreements, whether that's acceptable risk for farmers to take.
Mr. Chairman, I had an idea that it was a sort of a soft indexation. It wasn't just the pure application annually of CPI increase. Seem to recall that from some discussion.
Well, we're dealing with how these guys have researched it and are delivering it. So
it's certainly the assumption in the financial case is that it's a CPI claim. Yes. Yeah. So this slide's pretty important, because I think when we sort of originally talked to you about us doing this work, we did say that one of the key elements of our role was to make it very clear just how returns were constructed, because we're not looking at an investment from an HBRIC or council perspective where you're investing in a bond and you just get an annual coupon. It's quite a different beast to that, and so probably just get David to take you through these three slides, because they're quite important in understanding exactly how those returns get constructed, because, as I say, it's quite different to a sort of a more normative financial investment.
And I think for those that were in attendance at the previous presentation, our interim presentation, you might recall we had a sensitivities table there, and it had two columns in the sensitivity table, and the first column was the returns up to the trigger date, and the second column was the returns over the concession period. And unfortunately at that time we weren't able to share with you the shape and look of those cash flows, and it was sort of a difficult conversation to have in a vacuum. But what these charts are attempting to do, and I think they're on page 50 of our report, is that they're basically showing you the shape of the returns after tax to HBRIC over the period of both the whole concession, the period up until the trigger date, which is just a notional measurement date, and the period post the trigger date. So if we look at the top left-hand chart, that is the returns, and these are cash returns, to HBRIC over the whole of the concession. And what that's assumed to be is that's two consenting periods, so two 35-year resource consent periods. And you can see on the very far left, and I apologise for those people in the very back row, because obviously you'll have the challenge if you don't have a copy in front of you, but you've got a green bar that spikes below the line, and what that is that's the original investment by the council. So that's the $60 to $80 million band that goes out there. And then effectively thereafter, you've got returns coming in, and this is under the base case scenario. And what you have in those early years is quite low and small returns coming through. And you can see if you look down to the bottom left there, that's a slight increase in size on the period up until 2029, which is what we determined to be the trigger date. And the trigger date's effectively the date at which you reach full uptake and start exiting CII, or the Crown irrigation, sorry. And you can see in those early periods there's relatively low cash flow coming back. And in fact, the cash flow that comes back is quite lumpy, and it's primarily driven off a couple of events which occur, which are assumed to occur within the financial model, which is basically cash releases as a result of the investment structure. And what that does is that effectively back ends some of that cash flow after the trigger date, and then you'll see in the period, if you could see, but it's relatively small, is in the period from sort of 2029 through to 2050, which is the end of the first concession period. You've got a much more material cash flow coming through. And thereafter, you've got quite a large spike. So those that can read it will see a spike at about 2050, 2051, up to about $80 million. And what that is effectively that the financial model assumes that any bank debt that sits within the structure is repaid before the end of the first concession period. And that's obviously because any bank that is funding it won't want to take the risk around that consent. So if in the event there was a unforeseen event and you didn't get a consent for the second period, they would want to be out before that. And that spike is effectively a refinancing event. So what's that saying is post that first consent, you're awarded a consent, and then you're able to gear or put senior debt back into the structure, and as a result you get a large retribution of funds back to the council and to the other investors. And then thereafter you can see a structure which is a relatively consistent cash flow coming out, and then at the very, very back end of the top left graph you can see it dipping down in sort of a little sawtooth, and that's a result of repaying the remaining amount of senior debt before the end of the final consent period. And then I just add two more points, which is on the bottom left chart there you can see the pre-trigger date, and again I said that's just a notional period. So all that's attempting to say is, look, if the council was in up until the point that you had full uptake and you exited the Crown irrigation money, if you at that point sold your stake in the project based on using a market discount rate for the future cash flows of the project from that point to the end of the concession period, the end of the second concession period, that would be the market value as determined by the assumptions that's been used in the business case. That would be the market value of your stake, and effectively you're getting some cash returns on the way through, and you can see the spike there is sort of a full repayment of that initial capital plus a little bit. And that's simply just trying to show a measurement, which is really what would be your return if you were not an investor for the whole way through and you were an investor there to facilitate up to 100% uptake.
And the important thing is that when we show scenarios of the IRR, or internal rate of return, up to trigger date, those are the cash flows that are used to drive that calculation. Whereas if you're looking at the IRR over the whole period, then it's the top left-hand graph. And then if you're looking at the division between the pre-trigger and post-trigger, it's the right-hand graph.
Correct. Yeah. And nowhere in our report do we talk about returns post-trigger date, but effectively what that assumes in the top right there is if you were an investor coming in at that point, so if you were the person that bought the stake that was being sold by the council, that would be your set of cash flows that you'd be looking at receiving at that point. So it's basically a mirror, effectively, of the green spike at the right-hand side of the bottom chart.
And then we just ran a couple of other scenarios, David.
Yeah. So I mean, I think this was I can't remember the page, but around page 50ish of our report. one question we were asked at the previous meeting was some more aggressive scenarios around demand. So what we've put in there is a scenario which follows the low side case, so the extreme low side case. But effectively what that's saying is if you've really got it wrong and you didn't get demand right and you never got there, might be what the chart might look like. And this is just a sensitivity, but it basically says, look, 25% of the volume that you've built never gets taken up. So effectively you've oversized your dam by 25% and you're not able to sell that remaining portion. And under that scenario, and again it's just a scenario and there would be many options open to the investors, under that scenario you get the council will get a return of its money over a period of 29 years and then positive cash flows over the entire concession period. And we've dropped out in the sensitivity table, which is going to follow in a slide or two, what those returns would look like. And obviously, up until the trigger date, so up until 2030, the return looks, relatively low. Obviously, it's only a couple of % on an IRR basis. And over the whole concession, I think we're sort of looking at about 160 basis points, or 1.6% less than the base case, which is somewhere around sort of the 5.3% IRR.
But clearly what we can't, we've run this as a financial sensitivity and David will take you through the results of that. What we can't model or haven't modelled is if you were confronted with that scenario, what would you do about it? And you would expect that, there would be options in terms of sort of how you might think about pricing and what are the trade-offs between altering your pricing structure in order to get net higher revenues, etc. So you would expect that people would, at that point, think about options rather than just sitting there and having the water unutilised and unsold. But we haven't tried to speculate in terms of what those responses might be.
That